All right, let's get right into it. Think of this as a global financial detective story. We're talking trillions of dollars, massive hidden risks, and this incredible chain reaction that connects markets all the way from Tokyo straight to New York. It's a big one. So here's the central mystery we're going to try and solve. How in the world does a boring old bond in Tokyo have anything to do with a full-blown panic on Wall Street? On the surface, they seem like totally different worlds. But what you're about to see is how they're connected, dangerously connected by one of the biggest, most super leveraged bets on the planet. Okay, so our story actually starts right here in the US, right in the heart of the financial system. And this is where things start getting weird. Some really strange, kind of worrying symptoms have been popping up. These are our first clues that something is not right, something's brewing just beneath the surface. So here's the evidence, the first few pieces of the puzzle. You got to think of the repo market as like the essential plumbing for the entire financial system. It's what keeps the money flowing overnight. And right now, the safety buffers for that plumbing, they're vanishing. Bank reserves are going down. The main liquidity cushion, this thing that used to hold trillions of dollars, it's basically empty. We're seeing these sudden, crazy spikes in interest rates that are forcing banks to run to the Fed for an emergency backstop. The whole system, and this is the key part, is running with way, way less room for error. And boom, here's a perfect example. We're talking about a $13.5 billion emergency injection of cash from the Fed. I mean, this wasn't some minor tweak. This was a major emergency operation. When you see a number that big, it's a blaring red light. It's a clear signal that there's some serious stress under the hood, a massive thirst for cash that the market just couldn't quench on its own. Okay, so if all that stress in the repo market is the symptom, what's the disease? What's the underlying cause of all this? Well, that brings us to the main character of our whole story, the absolutely massive yen carry trade. So what the heck is it? Well, at its core, it's actually super simple. For decades, and I mean decades, borrowing money in Japan was basically free. Their interest rates were stuck at zero. So what do? You borrow that super cheap yen, you swap it for dollars, and then you buy something like a US bond that pays you a nice, healthy interest rate. The profit? It's just the difference. That's the carry. Simple, right? Let's break it down. Step 1, borrow basically free money. Step 2, swap it for dollars and buy stuff that actually makes you money. Step 3, pocket the difference. Easy peasy. And for years, this was like the ATM of global finance, one of the most reliable, most profitable trades in the world. And this trade funded everything: US government debt, tech stocks, even crypto. It was everywhere. So you're probably thinking, if this trade was so great, why is it suddenly in deep trouble? What changed? Well, the motive for why this whole thing is at risk, it's all happening inside Japan. There's suddenly a really good reason for all that money to finally come home. Just look at this. For the first time in an entire generation, Japanese government bonds are actually paying something. I mean, for decades, if you were a pension fund in Japan, you had to send your money overseas just to get any kind of return. But now they have a safe, compelling option right there at home. This is the game changer. This is the giant magnet that's starting to pull trillions of dollars back. And this chart just shows you exactly what that does to the trade. As those Japanese yields go up, the profit on the carry trade gets totally squeezed. I mean, what used to be a really juicy 3.7% profit, well, it's shrunk like crazy. The basic math, the very reason the trade existed, is just falling apart. Okay, and this is where it gets really, really dangerous. Because when a trade this big unwinds, it's not a slow, gentle process. No way. It can trigger this vicious, self-reinforcing doom loop that can turn a simple exit into a massive, cascading global panic. All right, let's walk through exactly how this snowball gets rolling. First, you get the smart money, the frontrunners, who start buying yen because they know the Bank of Japan is about to make a move. That initial buying makes the yen stronger. Now, that's bad news for the carry traders. They start losing money, which triggers margin calls from their brokers. So they have to sell stuff, stocks, bonds, whatever they can to get cash. And what do they need that cash for? To buy yen to close out their bad bet. But all that forced buying of yen makes the yen spike even higher, which causes more losses, triggers more margin calls, and the whole cycle just feeds on itself, getting bigger and faster every single time. And this quote, man, it just says it all. They call it the widowmaker trade for a reason, because the leverage is so insane, a sharp, sudden move in the yen can be absolutely catastrophic. We're talking about years of profits getting wiped out. gone in a matter of hours. And this isn't some textbook theory, folks. This has happened before. Okay, now we're at the final act, the big reveal, because everything we've talked about up to this point, the stress in the markets, the hedge funds being forced to sell, that's just the tip of the iceberg. It's the tiny part you can see sticking out of the water. The real danger is what's lurking beneath. And this is why it's so hard to get your head around the true size of this thing. You've got 3 different layers. First, there's the hot money. That's the hedge funds, the fast money speculators. That's about $350 billion. They're the ones that cause the flash crashes. Then you've got this massive kind of hidden layer of global banks using things called FX swaps. We're talking maybe $14 trillion there. But the real monster, the biggest piece of the iceberg by far, is what you could call Japan Inc. This is the slow, structural river of money from Japanese pension funds, insurance companies, and regular savers that's been flowing out into the world for decades. $20 trillion. Just let that number sink in for a second. It's almost impossible to comprehend. That's the potential scale of capital that's been propping up markets all over the world. And now, for the first time in forever, it has a reason to turn around and head back home. You see, that little unwind we saw in 2024, that was just the hedge funds, the hot money, getting washed out. That was the warning shot across the bow. The real question, the $20 trillion question, is what happens next? With this massive iceberg of capital now starting to move, what happens to all of us? What happens to global markets when the real shock hits and that money starts heading home for good?